You've probably heard whispers, or maybe seen the headlines, the taxman's on the hunt. This means Australian property investors should be on high alert as the Australian Taxation Office implements some new innovative strategies and forms some new alliances in a bid to recoup an estimated $9 billion of revenue deficits. So to discuss how to avoid getting trapped by the taxman, I'm actually going to be joined by the taxman, Tim Loh, Assistant Commissioner at the Australian Taxation Office, where we're going to discuss some things that should help you understand what your obligations are and how not to get yourself in trouble. So if you're an investor, this is a good time to be vigilant and informed, and that's what I hope to do in today's show. So let's get on with our chat with Tim Loh.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
No one likes getting emails from the tax department, do they? So when I received one a few weeks ago, I was a bit wary. But as I read the communication, I was excited because it was an invitation to have a chat with Tim Loh, Assistant Commissioner at the ATO, who was prepared to give us a peek behind the curtains and a better understanding of what the taxman's looking for, particularly when checking tax returns for property investors. So if you're a property investor, watch out because the taxman is looking after you carefully. So, hi Tim, let's have a chat.
Hi Michael, thanks for having me. It's a privilege to be on the podcast with you today.
Well, before we start talking about the Australian Taxation Office, maybe you can give us just a little bit of background about you and where you fit in.
Yeah, thanks Michael. Look, I'm an Assistant Commissioner for Risk and Strategy for Individuals and Intermediaries.
That sounds impressive.
Yeah, look, I'm looking at your return and everybody else's return come tax time. So it's a busy job, but also the other role I have is the tax time spokesperson. So you might have seen me on TV, radio, and obviously on podcasts like yours, trying to communicate and educate taxpayers around tax time and what's involved with tax time. So it's been a really great opportunity for me and, yeah, really pleased to be on your program today.
Well, I think that's really important because I don't think we should be scared of the tax department. We should know what the rules are. And again, let's be blunt, this is not specific advice for anyone, but let's get some information about what's happening because it is that time of the year again that people at the end of the financial year are preparing their tax returns. And I know each year the Taxation Department offers a list of things they're going to focus on. What can you share with us about what the tax department's focusing on this year?
Yeah, look, we've got three areas, but the area that's probably most relevant for your listeners is rental properties. So when it comes to investments, there are a few things on our radar which we want people to pay really close attention to this year. The first is incorrect reporting of rental property income and expenses, which is estimated to be about $1.3 billion. And what we're seeing is 9 out of 10 taxpayers are getting it wrong when it comes to their rental property income and deductions.
So what, 90% of people filling out their tax returns make errors? That's a huge number, Tim.
Yeah, it is a big number, Michael, and that's why we're very keen to make sure people get it right this tax time. So a lot of the things that we're seeing people get wrong relate to record keeping. So we're seeing people not have the right records or right books in order. So it's really important that, when you do have a rental investment property, that you have good records and you are talking to your registered tax agent about how those records come to them. Now, it's really important to note that 87% of those tax returns are actually lodged by our registered tax agents. So whilst our taxpayers need to provide their agents with correct records, we also need tax agents to make sure that they're asking the right questions of their clients in order to make sure their client's state of affairs is correct when it comes to their rental properties. Now, understanding your reporting obligations and keeping clear records Means you will get your tax return right and you are claiming the right deductions and including the right income in your tax return.
Well, I've been investing for a long time, Tim, and I remember the old days of paper records. And no, I don't think I ever had a shoebox. You know those old jokes
Yes.
where people brought the shoebox full of receipts to their accountants every year. But I know my sister still does that in the old-fashioned way. But nowadays there's more modern ways of keeping records. But let's start with a few things investors should know to get going.
Yeah, look, the first couple of things that I wanted to mention was you just can't claim the cost of buying your property. So this includes things like conveyancing and stamp duty for properties outside the ACT. Look, these expenses are still relevant to working out your cost base for capital gains tax purposes on the eventual sale of the property. So make sure you hold on to those records in your keeping. In fact, you are generally required to keep those records for at least 5 years after you declare your capital gain. And it may be longer if you do have a capital loss, and you typically have to hang on to them for an extra 2 years after you've offset the loss against another capital gain that you might have made. So it could be a capital gain that you've made in relation to other investment properties, or it could be capital gains you made in relation to other investments like shares and crypto.
Interesting, because we recently sold a property that we built 20 years ago, 2002, 2003. And we actually did have the original records because our tax agent, our accountant said, okay, you're going to have to pay capital gains tax. How do you calculate it? So we'll talk about capital gains tax in a moment because I think that's pretty important to understand. But fortunately, I am a good record keeper because we have got some good, simple computer programs to store them all in. But maybe let's step through the cycle of what happens. So first of all, you buy a property, you want to keep those records. The next step in the cycle is getting a loan and finance.
Yeah, that's right, Michael. When you do have a rental property, the odds are you're going to have a loan and interest to pay in relation to that. So when it comes to reporting interest expenses, it's another thing that we do see people get wrong come tax time. It accounts for 42% of the tax gap for rental properties. So 42% of effectively that $1.3 billion that I mentioned before. Now, for those who may not know, that tax gap is an estimate of the difference between the amount of tax the ATO collects and what we would have collected if every taxpayer was fully compliant with the tax law.
Wow.
Now, we know many people redraw from their investment loans to buy personal items such as cars, holidays, or even pay for school fees. And we're not saying people, can't do this, but we want them to be aware of their tax obligations before they make these decisions. Basically, what it comes down to is if the loan is for 25 years and they must apportion that personal component for the life of the loan. This is the case even if the loan is when the loan is refinanced. So you just can't simply pay back the private portion of the loan and claim all of that interest as deductible.
Let's make it clear at the beginning then that if you take a loan for an investment purpose and then all of a sudden you taint it with personal expenses, that makes it very difficult, very confusing to apportion it. So a good finance strategist would actually either get you to get split loans, separate loans, use an offset account. That's not what we're going to discuss at the moment, but it's where you actually mix it all together. How do you know what bit's what, Tim? That's hard, isn't it?
Yeah, that's right, Mike. You're spot on. Those couple of tips are exactly what people need to be thinking about instead. So it's really important that you're talking to your financial advisor or your registered tax agent to make sure that you're demarcating, what is in relation to your rental investment property versus what's related to private purposes. So if you can do that, it makes a real big difference, especially if we do end up auditing you in that rare circumstance.
Well, I know that there's a lot of information on the tax department's website. So in the show notes, I'm actually going to leave a link to something that you explain about rental interest expenses. I think this is critical. But in fact, the right time to do it, as you're suggesting, is right at the beginning. Set up your loans correctly and then run them correctly and run it as a business. And just don't confuse things by tainting personal and business expenses out of the one loan. Okay, so once you set up the loan, there's also expenses in setting up these ideas and structures. What of those can you claim, Tim?
Yeah, so Michael, when it comes to some of these other expenses, a typical expense that can come up is borrowing expenses. That's just one example. So in terms of the mistakes, we do see people try and claim that as a deduction in the first year. Borrowing expenses of $100 or less can be claimed immediately, but anything greater than that needs to be claimed over a 5-year period or for the term of the loan, whatever's shorter. So typically, if you've got a 25 to 30-year loan, you'd typically deduct it over 5 years because that's obviously the shorter period. Now, other expenses that fall into the same similar bucket are loan establishment fees, cost for preparing and filing those mortgage documents, lender's mortgage insurance or LMI, solicitors' fees, as well as stamp duty on the mortgage, which is not to be confused with the state and ACT stamp duty I mentioned earlier. Now, we've got a really great fact sheet that you mentioned before in our Investors Toolkit, which is on our website. So you can check that out, and it'll be on the show notes, which you can check out later.
Sure. Okay. Now, I know some people say, I'm going to buy a property and I'm going to repair it. And we like that idea. We like the idea of improving it and manufacturing capital growth. But they often think, hey, look, I can claim it as a tax deduction straight away. It doesn't work that way, does it?
No, it doesn't, Michael. We do know, initial repairs are tricky. We do quite often see deductions in the first year of ownership that are far higher than subsequent years as landlords, prepare the property for rent. And they do make that mistake of incorrectly claiming all their costs immediately. The important thing to ask yourself and to discuss with your tax agent is, did the defect, damage or deterioration exist at the time of purchase? Even if you're not repairing it straight away or you didn't know until a later date. Now, you can only claim the amount relating to gaining or producing your assessable income as a deduction. Otherwise, it's considered to be a capital expense. Now, this has been a real strong focus of our audit program for several years, and we're always trying to educate taxpayers and tax agents early in the rental property life cycle so they can get it right the first time. Now, because many rental properties are part of a strata arrangement, it's also worth mentioning that body corporate fees, like those general purpose or special purpose funds, can include amounts for capital works or improvements or repairs of a capital nature, which aren't immediately deductible. So something that tax agents should be checking really closely.
So when we talk about capital costs, really we're saying that they're part of the cost of setting up your business, of owning a property investment. And in due course, if you do sell, not that we're recommending people do, it'll be taken into account as part of the cost base for capital gains, but you can't necessarily deduct them straight away. But what if I say, hey, look, I need to improve my bathroom or my kitchen or add a carport. I actually do have to spend quite a bit of money. How's that handled?
Yeah, so it's going to depend on what you're doing in relation to your rental property. Now, with the capital works, as you mentioned before, Michael, you are improving the property. So those are things like, replacing the gutters, or rather than just repairing a rusted aspect of the gutter, or, putting a new fence instead of repairing the old one. So, typically speaking, capital works can be claimed at a rate of 2.5% over 40 years once the work has been completed. And as I said before, they're a little bit different to like just sprucing up the place with a fresh coat of paint or fixing a door handle, which comes under repairs and maintenance and can be claimed straight away.
Well, we're talking a bit about the capital costs, and it sounds like the depreciation. We usually recommend people who buy an investment property get a quantity surveyor to quantify depreciation assets. What can you tell us about depreciation allowances, Tim?
Yeah, when it comes to depreciation allowances, you've got things like your smoke alarms, range hoods, air conditioners, pool pumps, and, other appliances.
A lot of things people don't even think about, do they?
Yes, yeah. So like you said, it's good to have a quantity surveyor involved, so you've got a good idea of what you can claim, and they typically provide you with a depreciation schedule with all the things that you can potentially claim. And when they do that, it really does help you work out what you can and can't claim in relation to your investment property. And typically what happens with these reports is they outline what's in the property to begin with, as it would be effectively a decline in value or depreciation of the particular asset or depreciating asset, depending on how old the asset is. You can also work out whether those things, particularly those older items, can be claimed as a deduction or a decline in value. Now, some people think that if you're replacing something, it's an immediate write-off. Again, but that's only true for things that are less than $300. Otherwise, each depreciation...
What do you get for less than $300 today?
I know, with inflation going up, Michael, there's not too much you can. But there are the little things.
Yeah, of course.
But you're right. But when it comes to those more expensive depreciating assets for your investment property, they all have a different effective life, as you would know, and it really depends on the number of years it's expected to last. And we've got some really good information in our rental property guide that can help you work out which items can be deducted and over the number of years that's in their effective life. So it's contained in a fact sheet in our Investors Toolkit, and we've got a quick reference guide that people can use to also work out what's a repair and maintenance versus what's a capital expense.
Okay, well, that's another interesting factor because repair and maintenance is different to buying something new. And carpets last different lengths to curtains, last a different length to ovens and things like that. So that's where a quantity surveyor or a good tax agent will help you. Tim, there's been a bit of news recently about holiday homes and people letting them out part of the time, Airbnb, when they use it some of the time. Are they, well, I know they are, it's a loaded question. How are they treated differently to normal rental properties?
Yeah, look, it's a good point, Michael. So it really depends on how you use the property, which makes the distinguishment between what's a holiday home versus a rental property. You can buy a property as a long-term investment, but, if you're keeping it for yourself, family and friends, that's likely to be a holiday home. When you are using it as a holiday home, you can't claim deductions for periods where you aren't producing or making bona fide attempts to produce income from the property, for example, when you are using it for private purposes. So, this includes, advertising the property, but placing heavy restrictions to discourage potential renters. So we see a lot of that in Airbnb or on stays. So that's something that really focus on making sure of. So that things that we see people try and do are creating like excessive minimum stays, reducing availability, like blocking out Christmas holidays and the like, and charging higher rental rates than other equivalent type properties. So those are the things that kind of typically indicate to us that the property is for private purposes or used for a holiday home rather than maximising their investment income. So it's really important that people understand that we're really focused on that area, and we think it's not right that people are using the tax system to fund your holiday home, because it does take away money from the community for things like schools and hospitals.
Okay, look, I believe we should pay our fair share of taxes for schools and hospitals and I was going to say politicians, but maybe we shouldn't include that in the thing, but police and the services. So I have no issue paying my fair share of tax. But it's interesting. It looks like, I want to ask you this question in a moment then, that you obviously dig down deep if you can actually see what I'm renting out things for, what I'm, the restrictions I'm putting on. So I'd be interested to talk about how you do the data matching in a moment. I think that'll be fascinating. But let's just continue on with this theme about rental income. How about reporting rental income? How are you keeping a track of that?
Yeah, look, rental income is something that is obviously something that needs to be included in your tax return. It goes without saying, whether it's a long-term rental or a short-term rental. That bond money that has been retained to cover fixing any damage for rents also needs to be included in your tax return.
Now, that's interesting. I bet most people didn't know that. There'll obviously be an expense against it, won't there? But still, it's income.
That's right. And so it's really important that you include that in. But like you said, there's obviously a deduction component as well when you actually incur the expense to repair the item that's been broken by the tenant or damaged by the tenant. So it's something that people need to be aware of. Now, in terms of how we go about doing this, Michael, just to touch on what you said before, we get data from a lot of third-party providers. So people may not know, but we do get information from a lot of these short-term accommodation providers like Airbnb and stays. And what we do is we use that data from these third-party providers, and that includes also rental bond data, property transfer data from the state revenue offices, and as I said before, that sharing economy data. And what we do is we cross-match that data against the data that we have. So this year, for example, we've added property management data for 1.5 million taxpayers, residential investment property loan data for 1.7 million taxpayers, and also landlord insurance data for 1.6 million taxpayers. And what we do with this information is twofold. One is we want to make sure people, as I said before, get their tax returns right the first time. So we want to invest in a lot more education for both tax agents and their clients. But also, we will take compliance action where necessary to make sure that people get it right. Like I said before, we want to make sure we've got a fair and level playing field for all rental property investors across Australia.
Compliance action sounds like an interesting word. In other words, if you don't get it right, there are fines.
Yeah, so we don't go straight to fines. We obviously audit taxpayers, and, it's not a great place to be, an audit. It's like when you're a teenager and your mum and dad, you're cleaning your room. It's kind of like that, but a lot worse. We do sift through things with a fine-tooth comb in terms of all your information, records. So, my advice is to, speak to your tax agent and make sure you're providing them with all the right records, and also for tax agents to ask the right questions.
So you can't hide anything, not that you ever should have anyway. Now, again, I'm not able to give advice on this area, but I've always personally had a tax audit insurance. Not able to give advice on that, but it's probably tax deductible since I run a substantial property portfolio. And I actually have been audited a couple of times. I'll put up my hand and nothing's been found. It's nice and clean. But having said that, it is a little bit scary. It's a bit emotional when it happens, even though I knew there'd be nothing wrong there. But it's a way of protecting yourself by having audit insurance. And I know most accountants actually offer that to their clients. But recently, Tim, there have been natural disasters, floods, fires, other things. How do you include that? How do you take that into account?
Yeah, look, it's really going to depend on your facts and circumstances, right? But look, for example, if you do receive those types of amounts, for example, a compensation amount in relation to, your property or for income that you didn't receive from your tenants, that typically is assessable. But it really is going to depend on what the amount that you've received and what it relates to. So some amounts will be considered to be income, but some things will be considered to be capital nature. For example, if you've lost your house, for example, that's going to be something that's capital nature. But for example, if you haven't got the rent from your tenants and you're claiming on your insurance, that amount's going to have to be included in your tax return.
Sure. Most investors have property managers to look after them. They get a once-a-year, end-of-year return, and it breaks it all down. But I believe that some people don't actually report that correctly. And it's actually, I think, a genuine error. They're not trying to hide anything.
Yeah, there is a bit of confusion around interpreting property management statements. One mistake we are seeing is that taxpayers aren't reporting the gross rent on their tax returns. So they're not, it goes without saying, that's the full amount of rent that you get from your tenants before you get any deductions coming out of it. So we are seeing tax returns lodged with a net amount being entered, and then the deductions being claimed as well. So effectively double dipping, and everyone knows you don't double dip your chip in the dip, right? So
you get in big trouble for that.
Yeah, George got in trouble for that on Seinfeld. So look, it's really.
Are you
important.
a Seinfeld fan too? Are you?
Yeah. Who isn't, Michael? Right. So it's really important that people don't do that and take a really close look at those property management statements to make sure you're including the gross amount of rent and then claiming those expenses separately, including things like your advertising, property management fees, and any repairs and so on. So have a chat with your property manager about making those reports more detailed by itemising those income and deduction amounts, and also speak to your registered tax agent to help you get it right the first time.
Right. Now, some people end up selling their investment property. So we're talking about property investments here basically today, Tim. And currently the statistics are suggesting even more investors than normal are selling up. We could go into why with all the interference with the various legislation favouring tenants with higher costs, with highest mortgage costs. It's been estimated that currently over 30% of all properties listed for sale were investment properties before. And a recent report I read from the AHRIU confirmed older statistics also that 50% of people who buy an investment property sell up in the first 5 years. Some have made a profit, some haven't. Obviously, they've done something wrong if they get out so early. So what should investors take into account when they sell a property?
Look, as soon as you start thinking about selling a property, especially even before selecting a real estate agent for that matter, is if you're an Australian resident for tax purposes, you need to apply for a foreign resident capital gains withholding certificate, clearance certificate, if your property's contract price is more than 750K or more. Now, it's really important that you do that because whether maybe some of your investors don't know about this, but some of them might know, but you really need that because what can happen is if you don't have that certificate, 12.5% of the sale price is withheld by the purchaser and paid to the ATO, and you generally can't get that money back until you lodge your tax return for the following year.
So let's make it clear. It's not that you're a foreign investor. It's actually to prove that you are not a foreign investor so that there's no, let's call it, I may not have the right word, a withholding tax done. So when a transaction occurs, a purchaser has to withhold some of the funds in case I'm a foreign investor and not going to give the money to the tax department. So you're trying to prevent that.
That's right, Michael. So it's really important that, when you are thinking about selling that property, you get that certificate. It's something that we see people make a lot of mistakes on because they haven't got that. And it's really important that you do get one. And like you said, Michael, you spot on how you described it. It's just a way to make sure that if you are a foreign resident, that you don't run away and don't fulfill your tax obligation. So if you are an Australian resident, all you need to do, it's a really simple process to get the certificate. It can take up to 28 days or longer if there are some issues with it. And the certificates are valid for 12 months. So as soon as you start thinking about selling the property, just apply for one. It doesn't take long to apply. And then you'll be fine in terms of making sure that you get the full proceeds.
Well, your conveyancer or solicitor should be number one on their list, and I know it is for the people that we help our clients with. So, but that's something most people aren't even aware of. They don't think about. I'm not a foreign investor. What have I got to fill all this out for?
Yeah, that's right, Michael.
That's really good advice. That's valid for a year.
That's right.
Okay, what about capital gains tax?
Look, when a rental property is sold, it is disposable for capital gains tax purposes and must be reported in your tax return. It goes back to what we said before at the start, Michael, and you're really good at this. It's important to keep good records. Records. I'm going to sound like a broken record. So making sure you've got those records, the source receipts, those property management statements, the invoices are so crucial when it comes to getting your capital gains tax obligations right. Now, if your property has only ever been used as a rental, you need to work out the difference between your cost base, which is the cost of purchase and those ownership costs I mentioned before.
Not just the price of the property, but those initial costs that we talked about, the solicitors' fees, and maybe some extra costs that you put in at the beginning as well. That's right.
Yeah, and as well as your capital proceeds, what you sell the property for. So obviously when you do sell the property, there are costs that come out of it when you do sell the property, like obviously agents' fees that are taken out. So that needs to be included in your cost base. Now, keeping good records of what you spend on the property, as I mentioned before, like renos, repairs done while preparing to rent the property out, will make it easier to work out what's in your cost base and what's not, and working out your capital gain or capital loss when you do sell your property. Now, when it comes to your main residence, we all know that generally speaking, it is exempt from capital gains tax. But what we are seeing at the ATO is that some people rent out a room of their main residence through the sharing economy, like I said before, through Airbnb and stays. And so there are CGT consequences that may apply. So it's really important that if you are considering or you have rented out a room in your home, that you've got a market valuation of the property just before you started renting it out. So you've got a starting point for calculating your capital gains tax, rather than waiting, many years later to work that all out. And when you sell your property, you're kind of scrambling to work out what your capital gain is. As you would know, Michael, that if you do use part of that, your home, your main residence, to produce income, there will be a portion of capital gains tax that needs to be paid. So my best tip is to make sure that you speak to your resident tax agent to help you out in terms of working that out. Now, the other part of that main resident exemption that many people would know relates to is that the choice of using the 6-year rule. It's really important that people know that you can only use one main residence at a time when you are claiming that exemption, and you've got to make an election in your tax return.
I think one of the things we really should understand is the taxman knows what's going on. Don't think they won't notice these things. That's one of the lessons I just got from you, because you are data matching all these various sources. And I heard somewhere along the line, I read somewhere, the huge amount of money spent in your data matching and computer systems. So you can't hide these things, can you?
No, you can't hide, Michael, anymore. And like I said, there's probably 1.9 million properties, investment properties in Australia. Like, we've got data across probably, like I said before, 1.7 million to 1.6 million in different sources. So we just use all that data to work out who's doing the right thing. And if you're doing the right thing, nothing to worry about. If you are doing the wrong thing, it will come down pretty hard on you.
Now, let's be clear, there isn't a capital gains tax rate. So basically, you work out what the profit is. There's a 50% discount on how much you're going to get taxed on if you own an asset more than 12 months. And then that's added to your personalisation or your normal income. So therefore, different people will pay different rates of tax for the capital gain depending upon what all their other incomes are. Would that be correct?
That's exactly right, Michael. So obviously speak to a financial advisor in terms of working out when that the best time is to sell the property. Obviously, there'll be circumstances where you are forced to sell a property for whatever reason in a particular income year. But if you do have the choice in doing that, it's really good and really important to speak to a financial advisor because, like you said, it really depends on your marginal tax rates.
Well, you sound very friendly for a tax man, Tim. It actually sounds like the tax department is trying to do its job correctly and protect us all, but also trying to educate us and help us not make mistakes. So you're not trying to trip us up. You're not trying to trap us, are you?
No, we're not. Look, it's always about prevention before correction. If you think about it, there's 20,000 people working at the ATO. There's 14 million taxpayers. You can't audit every single person. So we just want to make sure people do the right thing. And it's really important that people understand that we are trying to make sure that people who are doing the wrong thing are stamped out. It's really important that people understand that we're out there to be transparent, and you can rest assured that we're working very hard at the ATO to make sure that people who are doing the wrong thing are caught.
Well, we've covered a lot today, and there's a lot more. I think we should have another chat in the future. But before we go, can you tell us where investors can go to get some more help or some more information, please, Tim?
Yeah, look, my best tip is obviously we know a lot of investors use tax agents, but we think it's really important that you check out some of the fact sheets that we've got in our investors toolkit. There's more than what I've covered today, and it's a really good resource to use, and you can find it on our website at ato.gov.au/investors toolkit.
I'll leave a link in the show notes as well, of course, Tim.
Awesome, Michael. And we also have a series of rental videos that are really useful for property investors just to have a squiz at. And then you can go into your conversation with your registered tax agent informed. And if you are lodging your own tax return, we do have some videos to show you how you can lodge your capital gains tax using our free platform, which is MyTax. But when it's all said and done, Michael, it goes back to that point you raised right at the start, and it's a really good point, which is it's all about the records. If you've got the records to back up your claims, it gives you complete and correct information which you can use to provide to your registered tax agent to get your tax return right the first time.
Now, I've used for many, many years a program called Evernote, which is on my computer, on my phone, on my iPad, and it even comes with a scanning app on my phone. So any invoices, even when I get a petrol invoice because I run a business and I'm allowed to run a portion of my car on that, I just take a quick photo of it and scan it, and it all gets stored instantly. I send it to my accountant as well in the business. But there are lots of programs that do that now, and you can file them under various things. So there's no excuse not to keep good records anymore.
No, that's right, Michael. That's a really good tip. And I think the thing is that you have to we want people to claim the deductions they're entitled to. Nothing more, nothing less, right? So if you don't have the records, you're actually kind of cheating yourself because you don't have you're actually not getting the right deductions you might be entitled to in relation to your investment property. So it's just all about records. And if you've got a good system in place, it's really important that you execute on that system and then engage with your tax agent early in the new year. This is a great time to speak to them to make sure your tax return for next year is right as well.
Fantastic. Well, Tim Loh, Assistant Commissioner from the Tax Department, thank you so much for your time.
Thanks, Michael. Thanks for having me. It's a privilege to be on your program today.
I hope you enjoyed my chat with Assistant Tax Commissioner Tim Loh, and there are some links in the show note to help you get some of those resources he's offered. By the way, if you don't currently subscribe to this podcast, before I go on to the next bit of my chat with you today, just stop for a sec and subscribe or follow depending upon which podcast app you're listening to this, so that twice a week you're going to keep getting information from my great guests. Now, in a moment, I'm going to share my mindset message with you, but I was just thinking that we're now well over halfway through the year. We're getting into the second half of the year now, and it's probably not a bad time to just look back and see what's happened over the first 7-8 months of this year, because learning from the past will give us some clues as to what's happening in the future. And if you think about it, all those issues that people were concerned about, some of the things you were probably worried about 12 months ago haven't happened. I mean, when you look at Investors were inundated early this year with news about stubbornly high inflation, rising interest rates, an ongoing war in Ukraine, fears of a coming recession, and consumer confidence has been low most of this year, lower than it's been for decades. And of course, there were also those usual group of experts out there, so-called experts, telling us that the property markets were in for further significant falls. However, we know that overall our housing markets bottomed out earlier this year, and since then both house and unit values have risen around the country and rents have skyrocketed. But in fact, the warning signs were there at the end of last year when we were regularly reporting asking prices were starting to go up and the rate of decline had slowed down. So what have we learned from all this? Well, I think one of the lessons is timing the market's a fool's game. You're not going to get it right. I guess it is also the lesson from Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. And I think another lesson to remember is there's always uncertainty in the future. There's always concerns. But underlying all this, our property markets have been amazingly resilient, and all those fears people were talking about haven't come. The fixed interest rate cliff, there was unemployment cliff a couple of years ago, there were other interest rate cliffs. You don't fall off any of these. What has happened, though, is 500,000 extra people came to Australia in 2022 and turned the supply and demand ratio on its head, and these high immigration numbers are likely to continue for some years yet, at a time when Australia just can't produce enough new dwelling stock. So if you want to learn how to take advantage of this new property cycle that we've entered, why not have a complimentary clarity consultation with one of our property strategists at Metropole? We're much more than just another buyer's agent. We help you safely create wealth, in fact, intergenerational wealth through property. And we believe that taking a proactive approach and a long-term focus is much, much more important than worrying about the short term. That's why we spend a lot of time looking at demographics and the fundamentals of our economy. Looking ahead, I think there's going to be challenges going on. I'm not suggesting there aren't going to be challenges, but I'm confident that if you own the right properties, in 3 years and 5 years' time, they're going to be worth a lot more. In fact, we're going to offer you, when you come and speak with us, strategies, frameworks I've fine-tuned over 5 decades we've been helping clients with for over 20 years. And while I can't guarantee the results you're going to get because there are so many unknowns, I can guarantee these are frameworks that have resulted in our clients being 7.3 times more likely than the average investor to own 6 or more properties. They're 7.3 times more likely than the average Australian investor to be in that top 1% of property investors. So why not have a chat with our team at Metropole? There's a link in the show notes, metropole.com.au. And as I said, we're much, much more than buyer's agents. We're going to start off by putting a strategic plan together. We're going to bring your future into the present and do something about it now.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to share a lesson I learned from one of my early mentors, the late Jim Rohn, who taught me we all have 2 choices that we face in life. He said each of us has 2 distinct choices to make about what we're going to do with our lives. The first choice we can make is to be less than we've got the capacity to be, to earn less, to have less, to read less, to think less, to try less, and discipline ourselves less. These are the choices that lead to an empty life, said Jim Rohn. These are the choices that once made lead to a life of constant apprehension instead of a life of wondrous anticipation. And the second choice? Well, the second choice, said Jim Rohn, is to do it all, to become all that we possibly can be, to read every book we possibly can, to earn as much as we possibly can, to give and share as much as we possibly can, to strive and produce and accomplish as much as we possibly can. Jim Rohn said, all of us have got the choice, to do or not to do, to be or not to be all or to be less or to be nothing at all. Jim Rohn said, like the tree, it would be a worthy challenge for us to stretch upwards and outwards to the full measure of our capabilities. Why not do all that we can, every moment we can, the best that we can, for as long as we can? Our ultimate life objective should be to create as much as our talent, our abilities and our desire will allow us to, will permit. To settle for doing less than we can is to fail at the worthiest of undertakings. Jim Rohn said the results are the best measurement of human progress. Not conversation, not explanation, not justification. Results are the measure of how you're progressing. And if our results are less than our potential suggests they should be, then we've got to strive to be more today than we were yesterday. The greatest reward, according to Jim Rohn, is always reserved for those who bring the greatest value to themselves and to the world around them as a result of who and what they've become. So Jim Rohn taught me the pathway of personal development, and that's why in each show I share with you a mindset message to help you understand how you can become a better person. And I hope today I've taught you that you've got two choices. You also face those. You can be as much as you can be or less. Which way are you heading? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports, my way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?